A new round of tariffs is set to hit nearly $20 billion worth of Canadian goods on August 19, 2026. 50%, no exemptions for goods that comply with the existing trade agreement between Canada, the United States, and Mexico. This is not a threat still being debated in the abstract. This is a specific date, a specific dollar figure, and a specific list of products already identified. In this script, we are laying out exactly what gets hit, why it is happening, what both sides are doing in the days leading up to it, and what the realistic range of outcomes actually looks like once that date arrives. Let's start with exactly what $20 billion in tariffed goods actually covers, because that number is not abstract. It spans a wide range of everyday products, dairy being one of the most significant categories, along with items like down jackets and a broader list of goods that had previously been shielded from earlier tariff rounds because they qualified under the existing CUSMA trade agreement. That protection is gone for this round specifically. Previous tariff actions throughout this dispute generally carved out an exception for goods that met the requirements of CUSMA, the trade agreement Canada, the United States, and Mexico negotiated together. This time, that exemption has been removed, meaning a much larger share of everyday cross-border commerce gets hit directly, rather than being shielded by the existing framework the three countries already agreed to. To understand why this specific list of products and this specific dollar figure exist, it helps to look at what the U.S. Trade Representative has said publicly about the reasoning behind these tariffs. According to official statements, the justification centers on three specific grievances: provincial bans on U.S. liquor sales inside Canada, Canada's supply-managed dairy system, and quotas Canada places on certain U.S. vehicles. Nearly every Canadian province and territory pulled American alcohol off store shelves at some point during this dispute, a decision made at the provincial level rather than by Canada's federal government in Ottawa. That detail matters because it shows this specific list of tariffed goods is not random. It is tied directly to specific policy disputes the U.S. side has repeatedly identified as its core complaints throughout this entire trade relationship. It helps to understand the broader timeline leading up to this moment as well, because this $20 billion figure did not appear in isolation. Trump signed an executive order in early February 2025, placing tariffs on Canadian exports at 25% across the board, with a reduced 10% rate, specifically for energy, critical minerals, and potash. That opening move kicked off what has become a year and a half of escalating rounds. A deadline in March of 2025 confirmed that initial 25% rate, and another deadline around August 1st, 2025, introduced a threatened increase up to 35%. Throughout that period, both sides adjusted their positions multiple times, with Canada issuing its own retaliatory measures at several points along the way. This current August 19, 2026 deadline, with its 50% rate and its removal of the CUSMA exemption, represents the most severe single escalation in that entire sequence so far, and the $20 billion figure attached to it reflects that broader scope compared to earlier rounds. Now let's talk about what has actually been happening in the days leading up to this deadline, because negotiations have been active and ongoing right up until the final stretch. Canada's Trade Minister Dominic LeBlanc has traveled to Washington repeatedly for face-to-face meetings with the United States Trade Representative Jameson Greer. As of the most recent reporting available, the two sides have not reached an agreement. Canadian officials have stated directly that they are not satisfied with the latest offer from the American side, submitted on August 11th, which reportedly proposed reducing some sectoral tariffs currently in place, but not by as much as Canada was seeking. In other words, going into this deadline, both sides remain at the table, but neither has gotten what it actually wants out of the negotiation so far. Prime Minister Mark Carney's government has reportedly been considering specific concessions tied directly to the underlying disputes. This includes potentially lifting the provincial restrictions that pulled American alcohol from Canadian store shelves in exchange for tariff relief specifically on automobiles and forest products, two sectors that matter enormously to the Canadian economy. That is the shape of the deal currently being discussed. Canada gives ground on the liquor issue specifically, and in exchange, the U.S. eases off on the autos and lumber tariffs that have been hitting Canadian exporters hardest. So what actually happens next, once August 19th arrives? Based on everything currently known, there are essentially three realistic paths this could take. There are three realistic paths worth walking through in detail, each with its own specific consequences for businesses and consumers. The first path is that the 50% tariff takes effect exactly as scheduled, with no last-minute deal reached before the deadline. If this happens, the immediate effect is that the full list of tariffed goods, dairy, down jackets, and the broader set of products covered under this $20 billion figure becomes 50% more expensive for anyone importing them from Canada into the United States. That cost does not simply disappear. It gets absorbed somewhere along the supply chain, either by Canadian exporters cutting their own margins to stay competitive, by American importers absorbing the added cost themselves, or by American consumers paying higher prices at the register. Historically, across this 18-month-long dispute, A meaningful share of tariff costs has ended up passed through to consumers and businesses on the American side, particularly in sectors like agriculture, lumber, and dairy, where Canadian supply makes up a significant share of what American buyers rely on. Within this first path, it is worth breaking down which specific groups feel the effects earliest and most directly. Importers who have existing contracts with Canadian suppliers, particularly in the dairy and apparel sectors given the down jacket category specifically named in this round, would see cost increases essentially immediately once the 50% rate takes effect, since these are not goods that can easily be resourced from a different country overnight. Retailers carrying these products would then face a choice between absorbing that added cost temporarily to avoid immediate price increases for customers, or passing the cost through right away. Given how thin margins tend to run in the dairy and apparel retail sector specifically, most economic analysis of similar tariff rounds earlier in this dispute suggests price increases tend to reach consumers within a matter of weeks, rather than being absorbed indefinitely by retailers. Dairy specifically deserves a closer look here, since it sits at the center of one of the three core grievances the U.S. Trade Representative has repeatedly cited. Canada's dairy industry operates under a supply management system, meaning production quotas and pricing structures are set through domestic policies specifically designed to protect Canadian dairy farmers from foreign competition, including from the United States. American dairy producers have long argued that this system unfairly limits their access to the Canadian market. From Canada's side, supply management has been treated as a politically sensitive, deeply entrenched piece of domestic agricultural policy for decades, one that successive Canadian governments across different political parties have been reluctant to dismantle, regardless of outside pressure. That entrenched position on the Canadian side is part of why dairy specifically remains one of the more difficult categories to resolve through negotiation, compared to sectors like autos and lumber where a numerical tariff adjustment can more straightforwardly address the dispute. The second path is that a last-minute deal gets reached either right before the deadline or shortly after, adjusting or delaying the 50% rate based on new concessions from both sides. Given the pattern this dispute has followed over the past year and a half, this is not an unlikely outcome. There have been multiple previous deadlines throughout 2025 and early 2026 where the threatened tariff rate ultimately shifted following last-minute negotiations rather than the harshest originally announced number simply taking effect exactly as first stated. That pattern has become common enough that traders and business analysts have started referring to it using a specific nickname, TACO, short for Trump always chickens out, reflecting the repeated pattern of deadlines being softened or adjusted at the last minute. Reporting on how Canadian businesses are currently behaving ahead of this specific deadline describes many companies engaging in what one report called watchful waiting, essentially betting on the same pattern repeating itself again, rather than making major supply chain decisions based on the worst-case outcome actually happening as originally threatened. It is worth being clear that this second path does not guarantee a full resolution even if it occurs. A last-minute deal could take several different forms, ranging from a complete rollback of the 50% rate back to a previous lower tariff level, to a temporary delay pushing the deadline further out while negotiations continue, to a narrower adjustment covering only specific categories of goods rather than the entire $20 billion list. Each of these variations would produce meaningfully different outcomes for businesses and consumers, which is part of why watching the specific language of any announced deal matters just as much as whether a deal gets announced at all. The third path is a partial resolution, where certain specific items within that $20 billion list get carved out or adjusted, based on progress made in the LeBlanc and Greer negotiations, while other parts of the tariff still take effect as scheduled. Given the specific, itemized nature of the current negotiations, with autos and forest products being the two sectors reportedly under active discussion for relief, this kind of partial, sector-specific resolution is genuinely plausible, distinct from either full deal or full, unmodified implementation of the entire 50% rate across every single covered product. Whichever of these three paths actually occurs, there is a deeper layer to this story worth understanding, because it shapes what happens well beyond just this one specific deadline. In February of 2026, the Supreme Court ruled that the President lacked legal authority to impose sweeping tariffs under the International Emergency Economic Powers Act, the law that had been the primary legal foundation for a large share of the administration's broader tariff campaign, not just against Canada specifically. Once that authority was struck down, the administration shifted to a different legal tool, a statute known as Section 338, a Depression-era law that had gone essentially unused for decades before this. One trade analyst described invoking the statute as the nuclear option for tariffs, specifically because it opens the door to applying tariffs more broadly than the previous legal framework allowed, potentially extending well beyond Canada to other trading partners as well. This legal shift matters for what happens next because it means the current dispute with Canada is functioning, in part, as an early test case for how far this newer legal authority can actually be pushed before facing another court challenge. If Section 338 tariffs against Canada face a legal challenge and get struck down the way the earlier IEPA-based tariffs did, that outcome would immediately affect not just this specific $20 billion list of goods, but potentially the broader legal foundation the administration is now relying on for tariff actions against other countries as well. That is part of why this specific dispute carries weight beyond the immediate dollar figure attached to it. Legal challenges to this specific use of Section 338 are already being discussed by trade law specialists as a real possibility, separate from the outcome of the current negotiation itself. If such a challenge were filed and made its way through the court system, the timeline for a final ruling would likely extend well beyond August 19th, meaning the legal uncertainty surrounding this entire dispute could persist for months or longer, regardless of whatever specific outcome gets negotiated between LeBlanc and Greer in the immediate term. That distinction matters because it means even a successful negotiated resolution to this particular $20 billion dispute would not necessarily settle the broader legal question hanging over the administration's tariff authority more generally. Legal experts covering this shift have specifically noted that Section 338, because it went essentially unused for so many decades, carries limited modern legal precedent establishing exactly how far a president can push it before courts intervene the way they did with EPA. That means any legal challenge to this specific round of tariffs against Canada could end up being decided in a courtroom well before the underlying trade dispute itself gets resolved through negotiation, adding yet another layer of uncertainty to how and when this entire situation ultimately gets settled. There is also a broader economic backdrop worth understanding, because it shapes how much room either side actually has to maneuver in these final negotiations. The US and Canada trade roughly $700 billion in goods annually, an enormous, deeply integrated relationship, where auto parts, in particular, often cross the border multiple times during a single vehicle's production process. That kind of tightly interwoven supply chain means tariffs imposed at any single point compound in cost at every subsequent stage of production, which is part of why the auto sector specifically has been flagged repeatedly by analysts as one of the most exposed industries throughout this entire dispute, on both sides of the border simultaneously. Companies like General Motors have specifically cited a trade uncertainty tied to this dispute in their own public forecasts heading into 2026. Canada, for its part, has already been adjusting its own trade patterns in response to the uncertainty created by this dispute. Canadian merchandise exports to markets outside the United States rose 17% year over year in the 12 months leading into January 2026, even as exports specifically to the US fell by 10% over that same period. That kind of shift, actively redirecting trade toward other countries, represents a longer-term structural change that would not necessarily reverse quickly, even if this specific $20 billion tariff dispute gets resolved favorably. Once new customer relationships get established elsewhere, they tend to stick, meaning the effects of this dispute could outlast the dispute itself. It is also worth putting some real numbers behind exactly how large the U.S. agricultural exposure to Canada actually is, since that sector often gets less attention in coverage of this dispute compared to autos. Canada has historically ranked among the largest export markets for American agricultural products, including grains, processed foods, and meat products, given the sheer scale and proximity of the Canadian market relative to other international buyers. When Canadian purchasers redirect a meaningful share of their import spending toward alternative suppliers in Europe, Asia, or elsewhere, American farmers and food processors lose access to a market that geographic proximity alone had made unusually convenient and cost-effective to serve. Rebuilding that same level of market access somewhere else, after losing it, generally takes considerably longer than losing it in the first place, since establishing new trade relationships involves its own separate negotiation, logistics, and trust-building process that does not happen overnight. This diversification trend also connects directly to what happens next for American exporters, specifically, not just Canadian ones. As Canadian buyers increasingly look toward other trading partners for goods they previously purchased from the United States, American exporters, in sectors like agriculture and manufacturing, face reduced demand from a market that has historically been one of their largest and most reliable. Regardless of how the current $20 billion dispute specifically resolves, that represents a slower-moving, less immediately visible consequence compared to the direct price increases consumers might notice on tariffed goods, but one that compounds over time the longer this broader dispute continues. The Bank of Canada's own economic modeling reflects just how much uncertainty is baked into this situation right now. Rather than publishing one single confident forecast, the central bank has laid out multiple distinct scenarios: a current tariff scenario, a de-escalation scenario, and an escalation scenario, specifically because the trade environment has proven too unpredictable to responsibly model with just one base case projection. Under the current tariff scenario, Canadian GDP growth is projected around 1.1% in 2026, gradually improving into 2027. Under a de-escalation scenario, growth improves further and inflation eases. Under an escalation scenario, both worsen considerably. The fact that a national central bank has had to build its entire forecast around several divergent possibilities, rather than a single clear outlook, illustrates just how open the situation genuinely still is. Economists have also already started measuring the cost of the disruption that occurred before this latest $20 billion round was even announced. The broader tariff cycle running through 2025 and into 2026 has already reduced Canadian GDP by an estimated 1.5% to 2%, with Canadian households absorbing somewhere between $1,700 and $2,000 in additional annual costs, according to independent economic analysis. Those figures represent real costs already realized before this specific August 19th deadline, meaning whatever happens next gets layered directly on top of costs that have already accumulated over the prior year and a half. It is also worth considering how financial markets have responded to this ongoing uncertainty, since market reactions often signal how seriously investors are taking the risk of continued escalation. Stocks and industries with heavy reliance on Canadian imports, particularly automotive and industrial companies, have shown periodic volatility tied directly to developments in this dispute, with share prices moving noticeably around key deadline dates and major negotiation updates. That kind of market sensitivity extends beyond specialized trade-focused investors, since these companies make up a meaningful share of major stock indexes that affect broader retirement accounts and pension funds. A currency dimension exists here too. A weaker Canadian dollar, which tends to follow sustained trade tension, makes American exports effectively more expensive for Canadian buyers, further dampening demand heading north across the border, while simultaneously affecting the value of American-held Canadian assets. It is also worth stepping back and considering what happens after August 19th, regardless of which specific outcome actually occurs. If the 50% tariff does take effect as scheduled, the cost impacts described throughout this breakdown begin compounding immediately, adding to costs that have already built up over the prior year and a half. If a last-minute deal gets reached instead, the specific terms of that deal will matter enormously, particularly whether it addresses the underlying legal uncertainty created by the shift to Section 338, or whether it simply resolves this one specific tariff round while leaving that broader legal question unresolved for the next dispute. And if the deadline gets delayed again, extending negotiations further, that outcome would reinforce the TACO pattern already shaping how businesses on both sides of the border are behaving right now, potentially deepening the credibility questions already surrounding how firm future trade deadlines actually are. None of these three outcomes fully resolves the deeper structural issues sitting underneath this specific deadline. The legal question about presidential tariff authority remains open regardless of what happens with Canada specifically. The deep integration between the US and Canadian economies and the two-way cost exposure that integration creates does not disappear based on one negotiated outcome. And the credibility question around trade deadlines, once established as a pattern, does not reset itself just because one particular deadline resolves in a way that avoids the worst case scenario this time around. So, bringing this together, what should you actually expect once August 19th arrives? Based on the current state of negotiations, the most likely outcomes fall somewhere between the second and third paths described earlier, either a last-minute adjustment covering at least part of the disputed tariffs, or a partial resolution, specifically touching the auto and forest product sectors currently under active discussion, while other parts of the $20 billion list potentially still face the full 50% rate. A complete, unmodified implementation of the entire threatened rate across every single covered product, with zero adjustment following the ongoing LeBlanc and Greer negotiations, remains possible, but would represent a break from the pattern this dispute has generally followed over its first 18 months. Regardless of which specific outcome actually occurs on August 19th, certain underlying realities do not change based on that one date. The legal question surrounding Section 338 and how far it can be used remains unresolved and will likely face further scrutiny regardless of how this particular round of tariffs plays out. The deep structural integration between the U.S. and Canadian economies and the two-way cost exposure that integration creates does not disappear based on one negotiated outcome. And Canada's ongoing diversification away from reliance on the U.S. market represents a longer-term shift that continues regardless of the specific terms reached in this particular round of talks. What happens after this deadline also depends heavily on whether the underlying disputes driving these tariffs, the provincial liquor bans, Canada's dairy supply management system, and vehicle quotas actually get addressed through this negotiation, or whether they simply get set aside temporarily while the core disagreements remain unresolved heading into the next deadline. Given that this is not the first deadline in this relationship, with earlier deadlines in March and August of 2025 having already come and gone through similar cycles of tension and last-minute adjustment, there is a reasonable possibility that even a resolution to this specific $20 billion dispute simply sets the stage for another round of tension down the line, rather than permanently resolving the broader relationship. It is also worth watching what happens to the specific list of tariffed products even after this deadline resolves in whatever direction it ends up going. Categories like dairy, which fall under supply management, a system Canada has defended as core domestic policy for decades rather than something it is likely to abandon entirely, regardless of trade pressure, represent an area where a durable, lasting resolution may prove more difficult than the auto and lumber sectors, where negotiated relief already appears to be part of active discussions. That distinction matters for anyone trying to gauge how much of this current $20 billion dispute is likely to get resolved quickly, versus how much represents a longer-running structural disagreement between the two countries that the single deadline is unlikely to fully settle. It is worth adding one final practical consideration for anyone following this story specifically to understand how it might affect their own household or business. If you regularly purchase or sell goods on either side of this specific $20 billion list, particularly dairy products or apparel involving down insulation, the days immediately following August 19th are the most useful window for observing how prices actually respond in practice. Since retailers typically adjust shelf prices within a few weeks of a tariff change actually taking effect, once existing inventory purchased at pre-tariff prices works its way through the supply chain. Watching actual price movements in the weeks following the deadline will likely give a clearer, more concrete picture of the real-world impact than any single announcement made on the day the deadline itself arrives. That is the full, factual picture of where things currently stand. Negotiators from both countries remain actively engaged as this deadline approaches. Canada has indicated it is not yet satisfied with the current offer on the table, and businesses on both sides of the border are largely taking a wait-and-see approach rather than making dramatic moves based on the worst-case scenario. The actual outcome of August 19th, whichever of the paths described above it ends up following, will become the next chapter in a trade relationship that has already gone through several rounds of escalation, negotiation, and partial resolution over the past year and a half, with real, measurable costs already accumulated on both sides of the border before this specific deadline was even reached. For anyone tracking this story going forward, the key numbers to keep in mind are straightforward. August 19th, 2026 marks the deadline itself. 50% is the tariff rate at stake. Roughly $20 billion is the value of goods currently covered. And the specific sectors most actively under negotiation for relief, autos, and forest products remain the clearest indicators to watch for signs of where this dispute is actually headed in its final days before and immediately after that deadline arrives.